This video is kindly being sponsored by Free Trade. If you want to try your hand at investing in the financial markets from as little as £2, you can get a free share worth up to £200 by signing up to Free Trade using the link in the video description below. You can think of asset management as a Ford Focus and hedge funds as a Ferrari. The Ford Focus is a standard car. It does everything you need it to do, but it doesn't knock the lights out in any particular area. In contrast, the Ferrari has a lot more power, it can reach higher top speeds and do so faster, and it's extremely attractive. It knocks the lights out in many areas. However, it does have some downsides. It's expensive, it's hardly got any space in the boot, and it can only fit 2 people in at any one time. What is going on YouTube? Welcome back to the channel. If you're new here, nice to meet you. Please do consider subscribing. Today we're covering a topic I get so many DMs on, and that is the difference between asset management or investment management and hedge funds. I'm going to touch on the key differences between the two, the key similarities between the two, which is easier to break into, which pays more, and everything else that you need to know if you're considering a career in either of these fields. So without any further ado, let's get straight into it. What is asset management? Asset managers make investment decisions about portfolios of securities on behalf of their clients under the investment objectives and parameters that the client has defined. Their clients can be institutions, pension funds, insurance companies, and high net worth individuals if you're in private banking or private wealth management. In simple terms, what this means is clients come to the asset manager with a ton of money, and they explain to the asset manager what they want to do with that money, how risky their risk appetite is, how long they want to invest for, and what areas of the financial markets they are happy to invest in, as well as what areas that they want to stay away from. For example, companies that are bad for the environment, tobacco stocks, so on and so forth. The asset manager typically has broad access all over the financial markets, and so they can offer the client a broad range of investment ideas and opportunities. Pretty straightforward, right? So what about hedge funds? So a hedge fund is very similar to an asset manager in that hedge funds take money from their clients and then they invest it into the financial markets. However, hedge funds tend to be smaller and focus on more niche asset classes and investment strategies. They tend to carry a lot more risk and provide clients with access to often restricted investment opportunities that asset managers might not be able to access. Hedge funds are known to take on more risk and leverage in order to attain larger returns for both themselves and their clients. Because hedge funds tend to take on more risk, they tend to charge higher fees and thus are more expensive for clients to invest with. Now we're going to touch on the key similarities between the two. Asset managers and hedge funds are both responsible for investing client capital into the financial markets. So they take money from their clients and they invest it. They do so hoping to make a positive return over a given time period. As a result, they both charge the client a fee for access to the investment expertise that the asset manager or the hedge fund is offering. Asset managers and hedge funds often invest in similar asset classes. The world of investing has different flavors that one can invest in. The flavors are called asset classes. Each has its own profile, pros and cons. Asset managers might invest in the fixed income markets or across the equity markets. Similarly, so too might hedge funds. However, very important, there's a key difference which I'll touch on later on in the video on this asset class point. Some asset managers actually have hedge funds within them. For example, Goldman Sachs Asset Management has a mini hedge fund inside of it. Another similarity between the two is that both are on the buy side. They're usually buying large sums of securities in the financial markets for investment purposes, as opposed to creating, structuring and selling them like a typical sales and trading floor or in corporate finance within the investment banking division that might be doing that. Now, if you're considering a career in a hedge fund or an asset manager, you're probably interested in finding ways in which you can stand out in interviews and increase your chances of securing offers and performing well in assessment centers. A simple way to stand out, especially if you're interested in an investing role, is to start investing with your own money. Now, this doesn't need to be a lot, like hundreds of thousands of pounds, don't be silly. You just want to show the companies that you're applying to that you've actively started trading and investing so that they know that you're aware of what's going on in the stock market and they see a genuine interest between you and the role that you're applying for. There are tons of online trading platforms out there for you to use. The platform that I personally use for my equity trading portfolio is Freetrade, who are also kindly sponsoring this video. I first came across Freetrade on Instagram and they promised commission-free trading within minutes. So I thought, let me check this out. So I downloaded the app and was able to trade equities such as Tesla, Netflix, PayPal, Google, and others within minutes. Some companies' share prices can be a little pricey. For example, one Netflix share costs around $500. The great thing about Freetrade is that you can use them to trade fractional shares. What is a fractional share? A fractional share is basically a fraction of a share. So if I wanted to invest in Netflix but only had £2 to invest, I'd be able to do that and invest that £2 in Netflix with Freetrade. As a result, I'd own £2 worth of Netflix as opposed to having to spend $500 to buy one full share. Here's why I like Freetrade. It's easy to set up, it's quick and easy, there's no hassle. When I have a question, I can message the team in the app and they usually get back to me quite quickly. Zero commissions on trades mean I can buy and sell shares without having to worry about an extra cost. Fractional shares allow me to buy companies that are typically quite expensive. And last but not least, they give away free shares worth up to £200. Free shares worth up to £200. So for everyone that signs up to Freetrade using the link in the video description, both you and I will get a free share worth up to £200 from Freetrade. And it goes without saying, always remember, when you invest, your capital is at risk. The value of your portfolio can go down as well as up, and you may get back less than you invest. Alright, key differences between hedge funds and asset managers. Hedge funds are typically more expensive and they charge higher fees due to the heightened level of risk taken on compared to that of a traditional asset manager. Whilst asset managers might charge a management fee of less than 1% or so, a hedge fund will charge anywhere between 1 and 2% for management fees, so managing that money costs them 1 or 2% of the capital invested, plus a performance fee of anywhere between 10 and 20, sometimes 30%. This performance fee is related to performance, and so it incentivizes the hedge fund to kind of do well and attain a certain level of performance or return so that they can get that fee because it's performance related. Hedge funds are less regulated compared to traditional asset managers. As a result, they can get away with pursuing riskier investment strategies, whereas asset managers can't. When all goes well, they make tons of money. When all doesn't go so well, they lose a ton of money. Most asset managers can be active or passive managers. Active management is when a portfolio manager is actively making buying and selling decisions for that portfolio. Passive management is when you have a pool of securities or investments simply tracking a benchmark or a segment of the market without any active management involved. Hedge funds are never passive, they're always actively managed, and hence why they can charge high fees. Hedge fund portfolio managers usually put a lot of their own money into the funds. They have a lot of skin in the game. The reason for this is to align incentives so that the hedge fund manager is actually managing the money to increase their own wealth as well as the clients. Because if it was just the client's money and not their own wealth invested as well, they wouldn't really care as much, right? Mutual funds tend to focus on traditional asset classes and long-only investment strategies. However, hedge funds take advantage of niche areas within the financial markets as well as shorting companies. So instead of investing only to predict that companies' prices are going to go up, they can also predict the opposite, companies' prices are going to go down, so that's short selling. In asset management, clients are investing in mutual funds, which means access to their money is very liquid, it's easily accessible. However, when investing with hedge funds, your capital is usually locked up for a longer period of time. This makes it fairly illiquid, so the opposite of liquid, illiquid. Which pays more? Both careers pay handsomely. You are, after all, in the front office in the world of finance and investing. However, it goes without saying that working for a hedge fund, you can expect a higher base and bonus at any level compared to working in asset management. As a junior with between 1 and 3 years worth of experience in asset management, you can expect a combined bonus and salary of around between £50,000 and £90,000. The same person in a hedge fund can expect anywhere between £60,000 and £150,000. In essence, across the hierarchy, hedge funds pay more in terms of base salaries, and they have a higher potential ceiling when it comes to earnings and bonuses. Which is easier to break into? The typical route into asset management is the traditional internship, convert that into a full-time offer, do a grad scheme, so on and so forth. However, it's not so easy and not so common to break into a hedge fund because they don't have like spring weeks or internships. They typically hire individuals who have 1 or 2 years experience in asset management or sales and trading or investment banking. Therefore, it's easier to start your career in asset management than it is to work in a hedge fund. A lot of people do move from asset management into a hedge fund. However, the move can be quite tricky because hedge funds are extremely selective when they are selecting their new hires. If you made it to the end of the video, smash the like button for the YouTube algorithm. I honestly appreciate your time and I hope you got something out of this video. If you did, leave a comment below. Let me know what videos you want me to make next, and check out some of these videos for more on hedge funds and asset management. Peace.